Welcome back to our accounting channel. Today we're diving into ASC 740, the Accounting Standards Codification that deals with income taxes. ASC 740 requires companies to account for the effects of income taxes on their financial statements. This includes current taxes, which are taxes that are due in the current year, and deferred taxes, which are taxes that will be due in future years. Current taxes are relatively easy to understand. They are simply the taxes that a company owes for the current year. Companies typically calculate their current taxes by multiplying their taxable income by the applicable tax rate. Deferred taxes are a bit more complicated. They arise when a company's book income differs from its taxable income. This can happen for a variety of reasons, such as when a company uses different depreciation methods for book and tax purposes, or when a company takes a tax deduction that it will not be able to use until a future year. When a company has deferred taxes, it must create a deferred tax asset or liability on its balance sheet. A deferred tax asset is a future tax benefit that the company expects to realize when it takes its deferred tax deduction. A deferred tax liability is a future tax liability that the company expects to pay when it reverses its deferred tax asset. The calculation of ASC 740 can be complex, but there are a few basic steps that companies must follow. First, companies must determine their taxable income. Second, companies must identify any differences between their book income and their taxable income. Third, companies must calculate their deferred tax assets and liabilities. Finally, companies must combine their current taxes and their deferred taxes to determine their total income tax expense. ASC 740 is reported on the financial statements in a few different places. The income statement shows the company's total income tax expense. The balance sheet shows the company's deferred tax assets and liabilities. The footnotes to the financial statements provide more detail about the company's income tax accounting. Here are a few examples to help further illustrate ASC 740 and its application. Example of current taxes. Let's say a company has a taxable income of $1 million for the current year, and the applicable tax rate is 25%. To calculate the current tax expense, the company would multiply $1 million by 25%, resulting in a tax expense of $250,000. This amount represents the taxes owed for the current year. Example of deferred taxes. Suppose a company purchases a piece of equipment for $100,000. For tax purposes, the equipment is eligible for a special depreciation deduction that allows the company to expense 50% of the equipment's cost in the first year. However, for book purposes, the company uses straight-line depreciation over 5 years. In this scenario, the company's taxable income would be lower than its book income in the first year due to the larger tax deduction. As a result, the company would create a deferred tax liability because it will need to pay taxes on the deducted amount in future years when the book and taxable incomes align. The deferred tax liability would be recognized on the balance sheet to reflect this future tax obligation. Example of deferred tax asset. Consider a company that has incurred significant losses in previous years, resulting in a net operating loss, NOL, carry forward. The NOL carry forward allows the company to offset future taxable income and reduce its tax liability. In this case, the company would recognize a deferred tax asset on the balance sheet. The deferred tax asset represents the future tax benefit the company expects to realize when it utilizes the NOL carry forward to reduce its taxable income and lower its tax expense in future years. These examples demonstrate how ASC 740 addresses both current and deferred taxes, highlighting the importance of accurately accounting for income taxes and understanding the impact they have on a company's financial statements.